Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and today we are really going to talk about this kind of overwhelming battle that we see, particularly among kind of the major analysts out there between are we headed for another bull market or is the bear market on its way? And it's interesting because there haven't been too many times in history where you can see a pretty strong case for either, kind of depending upon what data you are looking at. So we're going to talk about those things. It's hard to believe we're already coming into the very end of October. Last time we spoke, we were really talking about the correctional period that we were in for the month of September. And so you likely know that in that month, we closed down over 5% down for the S&P 500 for the month. And so October, I was kind of expecting may have been more of the same. You may remember this time last year, October, we were actually in the midst of a 10% true correction. Well, the opposite has really been playing out so far. We have a couple of days left in the month, but it's actually been a very strong period of performance for the market. And so just kind of goes to show that we can't always look at patterns to make determinations, but certainly we have seen some strength pick up in the market. But again, what I wanted to say was we're really just going to talk about, there's a really interesting dichotomy kind of happening right now within investors and kind of the feelings and thoughts. And so I thought that it might be beneficial for us to kind of go through and just kind of see just these two areas that really seem to have differing opinions, and just so that we can kind of take a look at the facts. And so first, we're going to just talk about some reasons why we may be able to say that the bull market will likely continue on, at least for the short term. So when we just look at seasonality in terms of, there's weaker areas, general performance for the market, and strong seasons of performance. Well, we're about to enter into the seasonally strong time for the market. And so we typically see, so we are right here in this red line here. And so for the rest of October, kind of be hit or miss. But then you see coming into November and December, remember last year we talked a lot about the Santa Claus rally that would come, as there's a lot of kind of window dressing that goes on for fund companies to kind of get ready for the new year. And so really trying to position themselves well. We also see a lot of buybacks begin to happen, stock buybacks from companies. Really November 1st is when we typically begin to see these really kick into high gear. And so that may, also help to kind of lift up these valuations. But again, it's kind of sometimes hard to compete with the fact that we're just entering into this season of strong performance. One thing to mention, we're in the midst of earnings expectations right now. And it's been interesting. I mean, companies generally they're doing well. They're coming out. They're meeting their expectations. They're giving somewhat of high forward-looking valuations as they kind of give what their futuristic thoughts are. And so in terms of earnings, it's just kind of been another somewhat of a strong reporting season. There's been some surprises here and there, but generally speaking, a lot is kind of continuing to give lift to markets right now. Something else, so it's very difficult to go against a moving tide, is what I like to say. And so when the market is overwhelmingly bullish and when people are overwhelmingly feeling favorable about the market, that will typically carry on for some period of time. And right now, investors feel very strong in terms of where we are in the bull market cycle, or that they absolutely expect that the market's going to continue to push higher. Now, interesting, a month ago, we flipped from being in greed to extreme fear. Just that 5% correction was really enough for investors to kind of get super rattled. We're right back to being in greed. And so I think that the idea, though, is that it's kind of like you go along, you get kind of drug along almost until suddenly that sentiment isn't there anymore. And so we saw the very same thing happen back in 2020 in February, as we had sky high valuations in other areas, but then there was this outside event that came on, took the market by surprise, which obviously was our economy having to go through a shutdown in the midst of a pandemic. And that was kind of that reverting event that caused greed to very, very quickly go to fear and for people to kind of head to the exits. But so for right now, the overwhelmingly investor sentiment is positive, is favorable, that the market's going to continue. And that's a very different, you can't really fight that. So it's almost like you kind of have to go along with it until it's not there anymore. So here's a couple of reasons, though, to point out about why we should at least kind of have caution, though, as we invest. Number one, economic growth is absolutely slowing down. Economic growth is kind of has some disappointing numbers, particularly when we look at GDP numbers. These are the inflation-adjusted quarterly change of GDP, and so you can see that we're kind of missing the mark here for Q3 and Q4, and there's a lot of reasons likely why we're seeing just in general economic growth kind of stagnate. Inflationary pressures continue to be an issue, supply chain issues. We've got significant amounts of cargo ships that can't even get into ports to kind of be disseminated here, and so that's a huge issue. Talking about things like the Fed is saying they are going to begin to taper QE as early as November 1st, and so all of these things kind of going against us, and also many of these are also causing us to find challenges in terms of finding new economic growth. And so something just to really keep an eye on, especially as we look at inflation, we look at if and when the Fed is going to decide to begin to raise rates, that will absolutely also have a direct impact on growth. And so something else I think is important is the fact that when we look at how many days we have gone since having the S&P 500 have come back to its 200 moving day average, and fairly significant period of time, 345 days. That's the last time that the S&P 500 came back down to its 200-day moving average. I'm going to show you in another slide exactly how far that would be, but it's just something to consider that it's a long time, and that while we can trade above our 200-day moving average for quite some time, as you can see, eventually they always do come down. That's the idea of averages. So that 200-day moving average is an average, so we can't trade so deviated from it forever. Eventually we need to come back down to it. And so again, 345 days is a very extended period of time. Could it go longer? Absolutely. Does anybody know what would cause a mean reverting event? No. That's kind of the whole idea. It catches us by surprise. In 2018, it was when our negotiations with the China trade tariff collapsed. 2020, it was the COVID virus and the impacts that it was having on the economy. What will it be in 21, 22? Nobody knows. Nobody knows if it'll even happen then, but the fact is that we should at least be kind of paying attention here, because this has definitely the significant implications for us. So now what I want to just kind of go through here is looking at the S&P 500 and kind of where we are. So I mentioned, how long it's been since we've had to come back to our 200-day moving average. This is our 50-day, this is our 200-day moving average. And so again, remember, law of averages, we have to kind of trade over time close to these numbers. And so certainly we've been extended for some time. Now, we broke the 50-day back in September when we were in the midst of that 5% correction. You can see other times in the past 6 months we've kind of come down to our 50, and that's acted as a nice line of support. We've bounced back off of it. But it's been quite some time since we've come down to our 200-day. Now, from today to the 200-day moving average would represent about 9.1% of a correction for us to get down there. So that would still be pretty significant, especially if that 5% correction back in September, if that was somewhat painful for you, then certainly 9.1 would be very painful. So this is really the time for us to be kind of like looking, make sure that we're in the right areas, do we have the right risk tolerance right now? If you were really uncomfortable in September, maybe you are a little more risky than you're comfortable with being. And so something else of concern, too, that we see is something called breadth that we see in the market. And so this is kind of like looking at the overall market. How many stocks are actually trading above their 50-day moving averages? And right now, only 60% of the S&P 500 is trading. When you look at individual stocks, 40% of them are trading below their 50-day. That's a sign that's an underlying weakness within the market. It's a technical sign that basically shows that maybe like the backbones of the market are not super strong technically right now. Does it mean that we're going to have a crash tomorrow? No, it doesn't. but it's the type of thing that when you look at in these areas, again, we have a lot of bullish sentiment on our side. We're coming into a seasonality time of strong performance. We still have gotten quite a bit of support kind of from the Federal Reserve, and so we've had a decent earnings reporting. So there are things in favor short term for the market, but just kind of long term, there are going to be issues that are going to have to be rectified at some point. And so really then, when's that going to be, and what areas then do we need to be, when should we be making position changes? Listen, if I knew the answer to that with a crystal ball, I wouldn't be here. Nobody actually knows. So nobody knows when the correction is going to come. You can run simulations and you can say, oh, it's looking like it's getting really close. But at the end of the day, nobody knows. The market's going to do what it'll do. But what you can do is ahead of time, there's some steps that we can take. We can make sure, number one, that we don't have more risk than we need to have. And number two, we can kind of follow a set of rules in investing. It's really important to not be emotional, but to be kind of to follow rules and to have a process. And so we like to let our winners run. We like to cut our losers quick. Okay, because if it's not working now, it's probably not going to work in this market. So that's something that you can kind of think of. Really make sure you know what positions you're holding and why you have them. Every position should have a purpose in your portfolio. So you should really understand why. And so what I'd like to show you now is one of the ways that we kind of make determinations of what should we be kind of maybe considering in our portfolio and what should we maybe avoiding? Because again, we want to let our winners run. Well, how do you find your winners? You want to cut your losers quick. How do you identify areas of losing? Because remember, losers eventually just become drags on your performance. And so we can look at something that uses momentum and relative strength to kind of figure out the winners and losers, and it can rank everything. And so right now, financials, S&P 500, equal weight, technology, all small caps, those are kind of areas of strength right now within the market, like significant strength, but then also looking the mid caps, large cap growth. Real estate has really been kind of moving up in this here. And so those are areas that that we've seen that have kind of been able to identify being areas of strength. And then conversely, being able to look at areas that have kind of been showing significant weakness, like emerging markets and precious metals, just might not be some of the best areas. Just kind of looking at money flows coming in and coming out, because again, we're looking at supply and demand and just really wanting to see what's going to give us the most favorable potential outcome for the long run. And so again, nobody actually knows. The only thing that we can do is kind of take steps proactively to make sure that, number one, we have the right amount of risk in each of our portfolios, that we're adding to the right areas, and then we're just monitoring things as they happen, because things change very quickly. And so we'll be here with you and looking forward to next week coming back and kind of having a discussion. We're going to actually recap everything that happened through the month of October, because that will be closed at that point. Then also being able to kind of take a look for the future for November and December and what some indicators may be pointing to. So thank you so much for joining us today. We are so happy to have you. As always, you can email me, AshleyR@victoryfiduciary.com, with your questions and your comments, and we'll see you next week.